How to avoid costly mistakes in spot trading. Proven strategies for success. Spot trading, one of the simplest forms of trading, involves buying and selling financial instruments like stocks, cryptocurrencies, or commodities for immediate delivery. While it offers significant opportunities for profit, it also comes with risks that can lead to costly mistakes if not approached wisely. This guide outlines proven strategies to help you navigate the world of spot trading effectively and avoid pitfalls. Now, the first pro tip is you must understand the market before you trade. The first step to avoid costly mistakes is understanding the dynamics of the market you want to trade in. And how do you do this? First of all, research the asset. Know the factors that influence its price, such as supply, demand dynamics, macroeconomic indicators, or industry trends. The other one is market hours. Spot trading operates 24/7 in some markets like crypto, while others like stocks have fixed hours. Timing your trades can affect profitability. Also, historical data. Study price charts, historical trends, and past volatility to make informed decisions. The number 2 pro tip is have a clear trading plan. A well-defined trading plan is your roadmap to success. It should include entry and exit strategies. Decide when to buy and when to sell based on specific criteria like price levels or technical indicators. Also, risk management rules. Determine how much capital you're willing to risk on each trade. Typically, traders risk 1 to 2% of their capital per trade. Also, profit goals. Set realistic profit targets to avoid emotional decisions driven by greed. The number 3 pro tip is practice proper risk management. Now, risk management is the cornerstone of successful trading. Without it, even profitable traders can lead to overall losses. Use stop loss orders. Protect yourself from significant losses by setting a predefined price at which you exit a losing trade. Also, position sizing. Adjust the size of your trades based on your risk tolerance and volatility of the asset. Diversify your portfolio. Don't put all your capital into a single trade or asset. Spread your investments to reduce overall risk. Number 4 pro tip, avoid emotional trading. Emotions like fear, greed, and impatience can cloud judgment and lead to poor decisions. To keep emotions in check, stick to your plan. Follow your trading strategy without second guessing. Take breaks, step away from the market if you feel overwhelmed or tempted to chase losses. Also, stay disciplined, avoid impulsive decision based on market hype or panic. Number 5 pro tip, use technical and fundamental analysis. Trading without analysis is like sailing without a compass. Incorporate both technical and fundamental analysis into your strategy. What is technical analysis? This is the use of charts, patterns, and indicators like moving average or RSI to predict price movements. Fundamental analysis assesses the intrinsic value of an asset by analyzing factors like financial performance, news events, and market conditions. Pro tip number 6, start small and scale gradually. For beginners or when exploring a new market, start with small trades. This allows you to 1. Learn from mistakes, gain experience without risking large amounts of capital. Also build confidence, understand the market behavior, and refine your strategies. Then test strategies, experiment with different approaches to find what works best for you. Number 7 pro tip, keep track of your trades. Maintaining a traditional journal helps you analyze your performance and identify patterns or mistakes. And these may include date and time of the trade, asset traded, entry and exit points, profit or loss, observations, and lessons learned. Pro tip number 8, stay updated on market news. News and events can significantly impact asset prices, so stay informed about economic data releases, industry updates, geopolitical developments, regulatory changes. Also use reliable news sources and trading platforms with real-time alerts to stay ahead of the curve. Number 9, avoid overtrading. Overtrading occurs when you trade too frequently or take on excessive risk. This often leads to losses due to high transaction fees, emotional burnout, increased exposure to market volatility. To avoid overtrading, stick to your plan and only trade when your criteria are met. Number 10, last but not least, learn from experts and continue educating yourself. The market is constantly evolving, so you need to stay informed, and this is very crucial for you to make profits. Now, follow seasoned traders, learn from their strategies, mistakes, and insights. Take courses, enroll in trading courses to deepen your knowledge of advanced concepts. And also stay curious. Continuously read books, blogs, and forums about trading to stay ahead of the trends. Now, on the comment section, we do have our masterclass on spot trading. So if you want to learn more about spot trading, the tricks that can make you successful, just click on the link on the comment section to get access to the masterclass. It is free, and I think it will give you more success as you continue to do your spot trading. Now, as I conclude, spot trading can be rewarding if approached with discipline, preparation, and a clear strategy. By understanding the market, practicing proper risk management, and avoiding emotional decisions, you can minimize losses and maximize profits. Remember, trading is a marathon, not a sprint. Success comes with consistency, patience, and the ability to learn from mistakes. By implementing these proven strategies, you will not only avoid costly errors, but also set yourself on the path to long-term trading success. Thank you very much. Please subscribe for more content.